So quick background on who I am. So I'm the tax director at Clive Owen. Started my career in 2002. Sadly didn't make it as a train driver as I wanted to as a child, and somehow fell into tax. Everyone I talk to just falls into tax. Nobody actually chooses it. Okay, so budget a few weeks ago, what actually happened? Well, personal tax, all tax allowances and bandings were frozen for 5 years. So there's sadly been no increase in your personal allowance or the point at which higher rate tax becomes payable. So nothing really exciting from that point of view. Capital gains tax was talked about potentially increasing, but he's left that alone for the time being. So corporation tax, this was probably the big tax change. We've got the return of the tiers. At the moment, the corporation tax for every company is a flat 19%. Many years ago, we used to have different tiers depending on the size of the company's profits. So he's gone back to the future, if that's the right expression, to effectively make the larger companies with the larger profits pay more tax. So we have a 19% rate, and this is from April 2023, for those companies earning less than 50,000 of profits. And we've got a 25% rate for those companies earning more than 250,000 of profit. We do have a nasty rate in between those two levels, which wasn't announced, but effectively any profits above £50,000 and below 250,000 are taxed at an effective rate of 26.5%. So again, that's something to watch for if you're in that middle band. You might think, well, okay, I could set up 5 different companies, for example. I've got 250,000 of profits. If I set up 5 companies, I'll make sure that each company has 50,000 of profits, pay 19% rather than 250%. Sadly, the government already a step ahead of you, and where you've got an associated company, those limits are divided by the number of companies. So effectively, the 250,000 will be divided by your 5 companies in that case, and your rate will be 25% on profits above £50,000. Any of the larger companies may pay instalments of corporation tax, so rather than paying 9 months after the year end, some of the larger businesses with more profits will pay what's called quarterly instalment payments, or QIPs. At the moment, you only look at kind of the group companies for working out whether a company would be liable to pay quarterly instalments. Again, that's going to go back to more associated basis. And what I mean by that is you've got a group of companies, they're kind of all under the, you have a group holding company, and then, different companies actually owned by that group holding company. What you need to look at is where you've got Joe Bloggs owns XYZ Limited and separately owns ABC Limited and separately owns DEF Limited. So they're under common control, not in a group situation. So that might affect the payment of the timing of the corporate tax being payable. Interestingly, they did extend the loss carryback period. So if a company currently makes a loss, they can carry that back against the prior 12 months profits. What they've said is, obviously due to the pandemic, that any companies that are making a loss between April 20 and March 2022 can actually carry that loss back 3 years. Given we're talking about accounting periods ending after April 2020, those accounts may have already been done and filed in your corporation tax return, so it'd be worth looking, if you have made a loss in that period, to see whether you can actually get some tax back. There is a point, at which, we will get asked, am I better trading as a sole trader or as a limited company? There are a lot of commercial factors that depends on, but from a tax perspective, depending on how much you want to draw out the company, because of the increasing rate is 25%, you might actually be better off as a sole trader. So again, there's a lot of commercial factors to consider. Whether you want to obviously lose that limited liability protection as a limited company, you could form an LLP to get that back and be taxed as an unincorporated entity. But that's something to think about and discuss with your accountants, because if you draw all of your money out of the company, you might actually end up paying more tax as a limited company. There's a rule on gross investment companies, which effectively means that they are just taxed at a 25% rate. these are kind of like your family investment companies, where the monies are invested in, bank and building societies, potentially into properties that aren't let at a market rate, things like that. It's quite a niche definition, but they don't get the benefit of the low rates of corporation tax. R&D, a lot of companies don't claim R&D relief, aren't aware of R&D relief, think it's a big scam. It's not. But, you get relief for R&D purposes based on the salary that you draw from the company, and that doesn't include your dividends. So a lot of companies are set up where the director shareholder will take £8,000 salary to get the national insurance credit for state pension and draw the rest out in dividends. Well, actually, they might be better off looking at a higher salary strategy if they're doing, a bit of R&D. Again, it depends how much they're drawing from the company, how much time that they're spending on R&D. But certainly, that's something to consider. That the 8,000 plus your dividend strategy might not work for the companies involved in R&D. So, the other big announcement was the super deduction. That is not me in a Superman outfit. Why did he announce this? Well, a lot of companies are sitting on cash. There's been a lot of access to cash in the last year, with your C-bills and your grants and things like that. And he wants those companies that are storing up cash to spend that money now. Why does he want to spend them now? Well, if they might delay it and think, well, if I buy something, I'll get 25% corporation tax relief in a couple of years' time. Whereas now I'm going to get 19% relief. So people might hang on to that cash and not spend and not restart the economy. So he's introduced what's called a super deduction for capital expenditure. So what can you spend it on? What does the super deduction mean? Well, you have to buy new plant and machinery. It's got to be brand new, unused plant and machinery. It can't be secondhand. It can't be something you've bought from, your brother's business or your sister's business. It has to be brand new, unused. You get 130% effectively an allowance. So if you spend £10,000 on a new van, under current rules, as things stand today, you can deduct £10,000 under the annual investment allowance, assuming you've got allowance available, hasn't been used by other associated companies, etc. For expenditure after the 1st of April 2021, you will be able to deduct £13,000. So you get a £3,000 boost. That's where your 30% comes in. Sadly, it's not available on cars. Any assets that you sort of buy and then you lease out, any acquisitions from connected persons. But, it's still valuable for those companies that are, looking to invest in, say, computers, machines, and things like that. There was a lower part of the super deduction announced, and that was relating to what we call integral features. Integral features are effectively what is embedded within the walls of a building. So you get relief obviously for your plant and machinery and equipment that you normally buy. You don't get relief for bricks and mortar and building. So the way I like to describe it is what one insurer once told me, said if you turn your house upside down, or you turn your building upside down, what falls out, that's your contents. Everything else is the building. So once you've got that empty building, you then look at to say, well, what is embedded within that building that I can get tax relief on? And what's embedded within that building are things like, the electrical wiring, the air conditioning systems, there might be a lift, there might be pipe work and things like that. You can get tax relief on those. So that's what's referred to as integral features. So you can get a 50% first year allowance on expenditure on integral features. At the moment, assuming you've used your annual investment allowance, you would only get a 6% write-off. So effectively, he's advancing the tax relief on that sort of expenditure. If you're selling an asset on which you've claimed the super deduction, then you might have to pay back some of that super deduction. Because obviously, if the thought is, well, I'll buy an asset for £100,000, I'll get 130% relief, then I sell it for £100,000 the next day. Well, there's a bit of a ruse there. So again, they've already thought of that, and you would need to bring in £130,000 as your sale proceeds when you sell that asset, even though you've only got £100,000 for it. So just something to watch for. Sadly, this is a corporate tax relief only. I think initially when he said it he didn't actually mention it was a corporate relief. So a lot of people, unincorporated and LLPs, like Clive Owen, for example, thought we might get the benefit of this relief, but it does only apply to companies. I've done a little example there just to sort of illustrate the point on, the benefits of this relief. So we've got a company that spent £1 million on just machinery. Obviously, we just say that's depreciated over 5 years just to make the accounting nice and easy. And the net tax cost is £36,000, because obviously you don't get your tax relief for your depreciation. Once the super deduction goes through, if you claim that, and obviously it has to be claimed as a super deduction, there's a negative tax cost of £21,000. So there is a saving to be had, but obviously as the numbers get smaller, the saving also becomes smaller. So just something to bear in mind. And what we'd always say is, you need to talk to your accountants about this, because timing is absolutely critical. Whether it's capital expenditure, looking at the annual investment allowance, whether it's looking at the super deduction, talk to them before you actually do anything, because you could make a fatal mistake in terms of the tax relief. What other points? The annual investment allowance is currently at £1 million. That will drop to £200,000 from next year. So again, that's your 100% write-off, not your super deduction. So the two will kind of coexist for the time being. They mainly cover the same sort of expenditure. So your £100,000 spent gives you £24,700 of tax relief, which is obviously grossed up, 130,000 at 19%. Obviously, come 2023, that'll be 25,000. So you can see why it's picked 130%. If you're looking at capital expenditure in the next few years, we've got the new kind of flexibility about the losses carried back. You can create a tax loss even though you haven't got an accounting loss, because of the way the tax allowances fall on plant and machinery. So, could you look to create a tax loss if you're going to spend money? There's no point spending money just to get tax back. But if you're going to spend money, you create a tax loss and you've got access to kind of those last 3 years where you claim some tax relief. So again, that might come into consideration. Watch how your capitalisation policies. We see many clients will kind of think, well, we've spent less than £2,000. We'll just put that through repairs, or we'll put that to the P&L. Obviously, if it goes through the P&L, you're only going to get 100% tax relief. So, we might spot it when we come to do your accounts and your tax computations and say, that needs to be effectively added back as an expense and claimed through the capital allowances. But if there's lots of those types of expenditure going through, it might not always be captured. So, it might be better to think, well, do I highlight that to my accountant at the year end? Or do I have like a separate place where I kind of put the types of expenditure that I would normally put to the P&L, like your tools and you might put a monitor for laptops and, bits and pieces. I might put that to the profit and loss account. Well, that's not going to get the benefit of the super deduction unless somebody highlights it. We'll just watch for that. Do you review your depreciation policy? While depreciation at the moment gets added back, and it will continue, it only gets added back at 19% corporate tax rate. In the future, it's going to be a 25% tax rate. Is there any way that you can advance that depreciation and take advantage of a lower tax rate? Just ideas. Again, everything's should be on the table for discussion with your accountants. Like I said earlier, you need to watch for any disposals of assets that you've claimed the super deduction on, and also when you're sort of buying assets in an accounting period that's what's called straddles, 1st of April 2023. So let's say you've got an accounting period 1st of July 2022 to 30th of June 2023. Your 130% allowance will be kind of prorated because the super deduction ends 31st of March 2023. So again, this is where you need to think, well, what am I going to spend in the next few years? Talk through when you think the expenditure is going to fall. Because you could get the timing wrong from a tax relief perspective. Other kind of smaller points that were mentioned, like I say, it wasn't a massive earth-shattering budget. But, there was an announcement of further self-employed grants, obviously for those that are self-employed, nothing for limited company directors in terms of anything else, apart from the furlough money that you can claim on your salary. There's a recovery loan scheme to be launched to replace the C-Bills scheme. We've got restart grants announced. I don't know if you know how much you know about Clive Owen, but we have a specific grants team. So maybe we're speaking to Carl Wright about any grants that are available. He's our head of grants advisory. There was an extension to business rates relief. There was a bit more positive news for hospitality when that reopens. The 5% VAT will stay in place for until towards the end of the year. Then it will go to 12.5%. And obviously the job retention scheme, the furlough was extended. There were announced to begin grants for hiring apprentices, and national minimum wage that's going up, which is good news. Company vans, if you have a company van or you have an employee with a company van, regardless of whether that van is a gas guzzler, is an electric van, the current year is you would pay tax on that van benefit if you used it privately. So what they've said is from next year, if it's an electric van, it doesn't produce any emissions, there'll be no tax on that van. We saw the stamp duty land tax relief that was extended. It's not as generous, but it's still there for the first few months of this coming financial year, and eventually will revert to the previous rates and allowances. Currently, if you file your tax returns late, there's normally kind of a flat penalty, and that increases depending on how late you are. There can also be tax geared penalties. But what they're talking about now for VAT and income tax is introducing effectively a traffic light system. So you get a penalty point, but you might not actually have to pay any cash if you're late with your tax return, your VAT returns, until you've maybe got 3 points on your license, so to speak. The reason for that is because of the changes to making tax digital, and I'll come on to those later. But obviously that's why they're looking at it. You potentially have to complete 5 tax returns a year rather than 1. So it'd be a bit harsh for them to keep charging every time you're late with a return. And obviously we saw the return of the 95% mortgages, so the government backed. So again, that's good to get the house market stimulated. I suppose the big announcement for our area, well, one of them anyway, when the first one came out about the Treasury, I thought that meant the Freeport wasn't happening, it would go somewhere else, but amazingly we kind of got both for Darlington and Teesside. So what is a Freeport? Well, it's a specific zone where goods are imported, but they're not actually deemed to have been imported into the UK. Once obviously they come out of that zone into the UK, then there will be duties payable. But you could have a situation where goods get imported in the UK, something's manufactured and goes outside the UK. So there'll be no duties because it hasn't actually entered the UK. Obviously the Teesside area has lost out a lot and lost a lot of jobs because of the closure of the steelworks. So this will encourage, well, this is what the government think, will encourage businesses to invest in the Freeport areas. So it's quite a coup really for the area, and there'll be lots of kind of spin-offs. There'll be the supply chain that feeds into the Freeport. So it's quite an exciting time. Obviously, there are certain eligibility criteria to be met in terms of whether they will allow you to have the Freeport relief and things like that. But that'll be announced further in the detail when it comes out. So what are the tax breaks for Freeport areas? Well, you're buying a bit of land. They're going to effectively waive the stamp duty land tax on that. You'll get business rates relief. You will get what's called enhanced capital allowances. So this goes beyond the period of the super deduction, the annual investment allowance. So you get 100% write-off on your spend. And if you're building a structure, so I know I said earlier there was no relief on kind of your walls and your windows and things like that. There is a special relief called structural and buildings allowance. So again, you spend £100,000 on your building, you'll be able to write some of that off against your tax bill. We're expecting that they will announce that there'll be no employers NI bill, or certainly a reduced bill for those companies that move into the Freeport area and employ workers. So again, it's another encouragement to move into a Freeport area. there might be a clawback. If you think, well, I know what I'll do. I'll build a manufacturing workshop in a Freeport area. Won't pay any stamp duty, land tax relief. A couple of years' time, I'll move that back out of the Freeport area and use that as a storage base. There will be a clawback in terms of reliefs given if that happens. So they're encouraging long-term investment. So in terms of the whole area, I think it was quite positive, and there've been quite a few positive announcements. Certainly, I think in the past we've been overlooked. From an area where Clive Owen operate, we've got the National Infrastructure Bank in Leeds, we've got Freeport at Humberside and Teesside. Obviously, got the Treasury North, moving to Darlington. That's going to generate jobs, because I can't imagine that everyone's going to move north from London. That could have an impact on house prices, which is good news if you're a homeowner. We saw the announcement about the GE jobs. So think up to 3,000 jobs, not all at GE, but between GE and the supply chain. Warburton's, which are sort of near me in Preston Farm, are investing in the area. We've also got Amazon in Darlington and Durham. So it was quite a positive budget for the Northeast. I know we're quite excited as a firm for the opportunities that it might bring to us and to our staff from a career development point of view. So just to kind of finish off with what we already knew was coming in. So we've got the changes to IR35, which impacted from April 2021. Now IR35 is what's known as Inland Revenue Interpretation 35, and it's effectively trying to stop those people that are effectively employees taking advantage of a tax break. So what was happening years ago was you might have had a computer consultant. He was or she was earning money, paying tax under pay as you earn, employers paying employers' national insurance. So they finished their job on a Friday afternoon. Over the weekend, they set up a company, Lee Watson Limited, and they come back on the Monday doing effectively the same job and supplying their services to a limited company. And why did that work from a tax point of view? Well, the employer, in inverted commas, would pay them £10,000, say there'd be no employer's national insurance because they're not an employee. They would get that into their limited company as a quite low rate of tax, and potentially extract that again at a quite low rate of tax. So the government were losing out big style. The way they introduced it at first was that if IR35 applied to your company, so if it was Lee Watson Limited, that an IR35 applied, that I had to put my hand in the air and say, here's a load more tax. Well, as you can imagine, anyone in that scenario didn't put the hand in the air. So it didn't really work from that perspective, because he was going to really volunteer to pay a lot more tax. So they changed it a few years ago, and they changed the way it worked in the public sector. So they said to public sector bodies like schools and hospitals, etc., look at your workers who are not on the payroll, and you need to determine whether their job is effectively an employee's job. And there are a number of factors, which I won't get into now, to determine whether you're an employee or an independent contractor. But it was then up to the paying body. So it was up to the school, it was up to the hospital, it was up to, ironically, HMRC used these, and the government used independent contractors to say, we believe you're an employee, we're going to deduct tax and national insurance from the payments that we make to you or to your limited company. From April 2021, they've announced that is to be imposed across the private sector. Now, it's only on those private companies that effectively have to have a statutory audit. So it's for the larger or the medium and large companies. So if you're a small company, you're probably not going to be affected by that if you're the employer. If you are an independent contractor working for one of these large companies, then you might find that you are impacted. So again, just something to watch for. You should have had your status determinations by now from the people that you work for, whether that's your BPs or your Amazons or whoever it is. They should be determining what your status is, and then it's up to you to appeal. But this is a big change. It was meant to come in last April. It was delayed because of COVID. It will come into force in a few weeks' time. We've got the reverse charge that came in on the 1st of March. So we've already had a few people not realise how it impacted their cash flow. So this is really for people operating in the construction sector. And the idea is it's to stop fraud going on. So if I'm an electrician working in the construction industry and I send an invoice out for £10,000 plus VAT, I would ordinarily have expected to get £12,000 in from the customer. I will then obviously put £2,000 aside for the taxman and pay it across. Sadly, not everyone had put the £2,000 aside for the taxman, so there was a lot of fraud going on. So obviously the company paying them were claiming relief for the £2,000 VAT, but then the company doing the work weren't paying that £2,000 VAT across to the taxman. So again, he was losing out. So if the reverse charge applies, effectively, if you're the customer, so I'm doing some work for Joe Bloggs Builders Limited, they've got to not pay me that VAT. They would just pay me that £10,000, and effectively they have to account for the VAT to the taxman. So again, it's that element of stopping that potential fraud going on. R&D. Sorry, I'm just going to take a drink. Again, I mentioned it's a very underutilized relief. For those companies that are making losses, you can make a claim for R&D. You can surrender your losses to the revenue and get a tax payment. But what the revenue is saying is now, because there's a lot of, they want to generate employment. So there's a lot of companies that will do R&D, but will subcontract out quite a lot of that work. So they're not paying any pay-as-you-earn employers' national insurance. So what the revenue are introducing is, if you're in that kind of scenario, they're going to cap how much of the loss you can actually surrender and get a tax refund for. Obviously, you can still utilize any losses going forward. But again, if you're in that scenario where you claim an R&D tax relief, you might find there's a kind of cap on how much money you can get back from the government. So Making Tax Digital, that's what MTD stands for. So at the moment, Making Tax Digital is there for the compulsorily registered VAT businesses. So those that are, turning over more than £85,000. For anyone in that scenario, you have to keep your records digitally. So on some sort of cloud system, Xero or QuickBooks is preferable. And, that system will submit your VAT return direct to the revenue. That from 2022, that will apply to all VAT registered businesses. So those that, couldn't comply because they were too big, or, those are voluntary registered businesses from a VAT perspective, will have to comply with Making Tax Digital. From 2023, anyone that effectively runs a business and generates more than £10,000 of profit will have to comply with Making Tax Digital. So anyone in that scenario will have to get some sort of, digital system, whether that's a Xero or a QuickBooks. So you won't be able to go into your accountants with your paper bag full of records, or just email a couple of spreadsheets saying, hey, can you pull my tax return together? You have to keep your records on some sort of software. The software is quite cheap. It's quite intuitive. Our recommendation is get it now before you have to get it, so you can get used to the system. You can get everything kind of lined up. And again, our what's called comms, Clive Owen Managed Services, we can tell you what the system is best for you. Some of them work best with different banks. Some of them have a lot of kind of apps that, feed into them, to help you. Because, what you don't want to be doing is doing an accountant's job. You don't want to be sitting sort of, working out, what expenditure through the bank goes where, etc. They're quite intuitive, they work quite well. But this is going to catch a lot of businesses out, especially at the smaller end of the scale. So, if you've got a little consultancy business, say it turns over £5-6 grand a year, and then you've got a buy-to-let property that has income of say £6 grand a year. Together, combined, that's more than this £10,000 limit. So you're going to have to report digitally for both of these effectively businesses. What's also apparent is that you're going to have to submit quarterly income and expenditure statements to the revenue. So, this is where I said earlier, you're going to do 5 tax returns a year, not one. You'll have your 4 quarterly submissions, and then there'll be an end of year submission. So, we need to, you need to make sure that you're ready for these changes coming, because this is going to impact massively. And obviously there's a cost to it as well. FYA stands for first year allowance. Again, this is another capital allowance. If you were buying a low emissions car, for example, up until the end of this financial year, and you can potentially write off the full cost of that car against your profits. From next financial year, you can only write that off if it's a zero emissions car, which is effectively an electric car. So, if you're looking at, getting a low emissions car, I'd get on it pretty quickly. The other change is non-residents buying UK property are going to be hit with a stamp duty land tax surcharge. So they will pay a bit more stamp duty land tax when they buy the property. So looking ahead, the budget is meant to happen every autumn. That was the change they made a few years ago. Obviously delayed in autumn 2019 because of the general election. And obviously happening there was need to be one for that financial year. So it happened last March. Again, it was delayed this year until March again. There were rumours of, things like wealth taxes coming in to repay for, because we've got to pay some of the monies we borrowed from COVID back. There'll be tax increases in terms of capital gains tax and inheritance tax. There might be cuts to kind of pension tax relief. There might be other things like currently if you earn more than £100,000, you don't get your full £12,500 personal income tax allowance. That might drop to £80,000, for example. But, the autumn 2021 budget, you need to think ahead. If you're going to sell your business, for example, and, bank your current tax rates because they haven't changed, because that could see a big shift in terms of the capital gains tax rates. If you think you're going to get 10% and suddenly stands up in the autumn, says from today it's 40% capital gains tax for selling your business, then you're going to kick yourself because you're now paying 4 times more tax. So again, it's just forward planning. Just what are your plans? You might not want to sell your business, and that's fine. But it's time that you were talking to your accountant about what your plans are for the future. This could come in and be a real change, a real kick in the teeth if the rates are going to go up. Should you be putting money into pension now while you know what the reliefs are? Again, these are things that your accountant should be talking to you about. That's it for me. So it's a quick fire run through on the budget. If there's any questions, I'm happy to take them now.
Can I just ask Lee about the carry back? You said 3 years.
Yeah.
Is that 3 years from April 2021, or is it 3 years from?
So you look at your accounting period that ends after April 2020.
Right.
If you've got a May 2020 accounting period and you made a loss in that and you didn't have enough profits in the previous 12 months to utilise that, so you've ended up carrying some of that loss forward, you can go back and say, well, I want to carry them back now 3 years rather than 12 months.
It's really quite useful for people who have are looking at the last 12 months of accounts and seeing a sort of a red figure.
Yeah.
So they can utilise that really against whatever they're doing this year. So that's good.
Yeah.
Anybody else with a question?
Lee, do you want to stop sharing your screen and then we can see everybody's faces?
I know, I'm trying to.
How are you? I was going to say, because I can't see. It's nice to see everybody, isn't it?
I know, I don't know how to do it.
So I'm not the only one with technical issues today then.
It's just got everyone's faces on my screen. Oh, wait a minute, stop share. It's on the other screen. So I've got 2 monitors.
There we go.
That's why I kept looking at that screen.
I'm sorry, I should have said earlier, if you had questions, you could put them in the chat box, but I forgot. Sorry.
I was intrigued by this middle rate for the corporation tax, which seems to go against the making tax progressive rule, and most SMEs will probably fall into that middle band, won't they?
Yeah, I mean, it's still less than 25% altogether, but obviously what it means is that up to £50,000 you're paying 19%. Anything above that you're paying 26.
Right.
So it's not 26.5 on
all
the
right, okay.
If you earn £60,000, might you be better off doing a pension contribution? Because effectively, you're going to, if you bring your profits down from 60 to 50, well, you've saved 26.5% on that 10,000 excess.
The restart grants, is that for an existing business, perhaps sort of going off on a different sort of avenue of business altogether, or what? What are we terming a restart?
I think it was more of those businesses that have been kind of hard hit, during the, and had to close down, things like your leisure activities, your hairdressers and things like that. That's how I understood it. It was to kind of get them businesses back up and going.
Right. Okay. So someone that's had a dip in fortunes, and they can get a helping hand to get things moving again. Yeah. Yeah,
potentially. Yeah. So grants isn't my area of expertise. It might be worth having a word with Carl Wright, who's based in our Dalton office.
We know Carl. He's done a talk for us as well. So, okay. Jason, has anyone said anything about the Freeport or the Treasury people coming to Darlington?
Not at the moment. We've got the forgot the guy's name now. Local MP Peter Gibson coming next month, but that's more about the Treasury. We're trying to get Ben to come over and talk, but at the moment there's nothing confirmed yet because obviously they've got a lot going on at the moment. Yeah,
I think it is like Lee was saying. It's got to be good news for the whole area, really, because those sort of little building blocks will build, and there'll be input from people in our part of the world over to Teesside. Has anyone got any links over to Teesside businesses at the moment that will be involved with the Freeport?
We do a bit, David. I mean, what I would also say is that I was on a call yesterday with, no, I wasn't involved in it, but we set up something for the York office, because, we have an office in York as well. Yeah. So we have a mock MPC, so like a shadow MPC. So obviously the real MPC sits on Thursday. So we have a team of York business. We do it in the Northeast as well, actually. It's reported in the Echo today. But the York one, we did on Monday, actually. And they were talking about this confluence effect, because we've got a Freeport at Middlesbrough now. We've got a Freeport at Humber. We've got the Treasury jobs. We've got the wind. But we've also got that massive infrastructure bank in Leeds. So they're talking about, the communication network going to be so significant. It's going to increase the whole of this region, So I think it's super exciting, actually, for all sides of the businesses. I just think it's a great opportunity, and it's going to bring people, it's going to bring jobs, it's going to bring excitement. I mean, the York people were really very positive about it.
Yeah.
Lee, you might not be able
to improve all sorts of things. Transport. Yeah. I mean, I don't travel over to Middlesbrough, but I know it is a pain to get London to Middlesbrough. Just doesn't happen without a few changes of trains and that. So, yeah, got to be good news, and the ripple effect will come over to even to us in Richmond. Sorry, Phil, you were going to say?
What's to stop? I've forgotten the name of the company in Eaglescliffe that makes plastic bits for Nissan. What's to stop them closing that factory in Eaglescliffe and moving it into the Freeport? Because that will not create new jobs, will it? I mean, it'll obviously be cost effective for them, because a lot of their stuff will be going into Europe and all sorts. But is there anything to stop people doing that, taking an existing business and essentially moving it into the Freeport? Because if you fill it up with existing businesses, we've not gained anything, have we?
Yeah. I'm not sure that there is. I haven't read the detail in great depth, but
I don't think there is a lot of detail yet, is there? I think poor old Ben's going to be it's going to be Question City, isn't it? I do think, actually, we held I don't know, do you remember we held a budget event just before lockdown last year? It was one of the last events, and we actually had Ben and Peter at it. And I'm sure Ben made reference, don't hold me to this, but I'm sure he made reference to communication networks being improved. You know, I think it was further along the route, but they're aware that, you know, Darlington, you know, they're doing stuff with the station in Darlington, they're looking at improving that. So presumably Middlesbrough's on that, because you're absolutely right. It's a bit of a chew, isn't it? But it'd be good to think it is, wouldn't it?
They were talking about a tram, weren't they, at one point between Middlesbrough and Darlington? But I don't know whether that...
I think it'll evolve, won't it, Phil? I think it'll evolve.
Well, there is an existing rail line that just hardly ever gets used. It's so
slow, that's why.
Pardon?
It's very slow.
Yeah.
You're better off using a 66.
The trains
you can actually go faster by bus, which is ridiculous.
Yeah.
Well, it's a bit of a chicken and egg situation, that one, I think. But I would suggest all of the transportation links in the whole of the north need some investment. You ever try getting over to Manchester? It's a struggle. Anyway, coming back to research and development, Lee, am I right in thinking that if you're an existing business and you do consider looking at a tangent away from your mainstream business, if you keep sort of receipts for any new literature or any market research that you do, that will be considered as research and development costs?
No, it's quite specific to research and development costs. So remember, it's only a corporate tax relief, so you have to be a company to claim the relief. And then the costs that you claim are things like salaries, pensions, employees' national insurance on, you know, the workers that are doing the R&D, things like software to undertake R&D. You know, if you're developing, you know, an actual tangible product, you know, the consumable materials and things like that. Yeah. So yeah, the market research isn't necessary, whilst it's kind of research in terms of the general word research, it's not, doesn't qualify for R&D tax relief, you know, yeah. Unless obviously it's research into, you know, well, how do I resolve this, or, you know, what sort of materials, yeah, but general market research saying, you know, would this new DVD player sort of, you know, be good on the market, that doesn't qualify.
All right, okay.
Lee, on the R&D,
yeah.
We've been approached many times by companies saying, oh, we'll do it for you, we'll fill in the forms, blah, blah, blah. And I cracked once and did one process, and they said we were too small, we weren't turning over enough. Now, I assumed that meant there was some sort of lower limit, but I'm now thinking it was because they couldn't be bothered, because it wasn't lucrative enough for them. So is there a way I can do it just myself?
Yeah. There's no harm in you doing it. You know, what we would normally do is do a report to the revenue, saying, you know, what sort of organisation you are, what's the background, what sort of costs you incurred, and what's the project. You know, so there's 4 key questions to answer.
We write bespoke software, so almost everything we do is created new.
Yeah.
But whether it counts as R&D, I don't know.
Yeah, well, what you need to resolve is whether there's some sort of scientific or technological uncertainty. So, you know, something might take you a long time to do. Is there some sort of uncertainty? And was that resolved by a competent professional? You know, so it's not like it's me, you know, writing a software program, because, you know, I wouldn't be regarded as a competent professional. Whereas, you know, had you used a competent professional, it would have been easy enough for them to resolve. So that's the big factors to get over, the uncertainty and the competent professional test.
Okay.
But I can certainly send you our guide if you want something to go on.
Yeah, that would be handy if you could send that, Lee. And Phil and I will distribute that if you don't mind.
Yeah, okay, I'll do that, yeah.
But the message I'm sort of trying to get at really is research and development isn't all in a lab with people with white coats on. It's something that we all might be looking at, and maybe just absorb the costs, but there's relief there that should be taken. So Okay.
We certainly at the City Secret, we've benefited from the R&D, not so much in the last few years, but previously, and it's hugely beneficial. And I think, Craig, I would always avoid the companies that ring you up. They often will tie you in, so future claims, they get a percentage of. We have always done our claims through our accountants. So currently we're with Clive Owen. I just don't see there's a need to use these specialist companies because, as I say, they will claim back on future claims. Whereas if you go through your accountants, they generally don't tie you in like that. You know, they're there to help. And so I say avoid, similar to the ones that claim that they can get your business rates relief dropped. Avoid those as well. That's my personal opinion, but sorry, nobody's in that business, are they? Need to apologise.
Actually, Sophie, I've just started up a new business.
Sorry.
Capital gains tax, Lee. Any thoughts for the future? Are there any whispers as to who might get hit? Because I'm looking at a screen here, and I'm looking at people with loads of money, basically.
Well, I think that's why you can see the rise coming in, because it's seen as a wealthy person's tax. You know, it won't affect the vast majority of the population. You know, it's targeted business owners, those with second properties, and things like that. Or, you know, massive share portfolios where, you know, they've done well because of the stock market. So the vast majority of the population would be, you know, okay, well, it doesn't affect me. I don't see the fuss. So there wouldn't be as much of a kick up, but obviously it is a bit of a kick in the teeth for, you know, if you've built a business from nothing, you know, and then, you know, it comes time to sell, you know, you've put your blood, sweat and tears into it, you've drawn money out of the business, you paid 40% tax all along. It's to then say, well, there's another 40% tax on the value that you've built is a bit of a kick in the teeth. But, you know, on the other hand, you know, the government have got to raise, you know, taxes because we're just massively in debt. So, you know, you can see that coming in. I think it was probably best avoided this time because you just don't want to keep putting bad news. I think, you know, once we're up and running again, you know, once the vaccine's kind of in most people, you can kind of see it being like a good time, and it might just kind of get washed over. But I think it's coming. I don't think there's any avoidance. I think, you know, they've put the capital gains tax rates up a few years for residential properties. They've asked those people that sell residential properties that aren't the main home to pay within 30 days of selling that to generate cash flow. You can see taxes rising. Undoubtedly. Yeah,
fair warning.
Yeah.
Okay. Any other questions? Okay. Well, that's very nicely bringing us up to just before 11 o'clock, and I know there's a couple of people have to head off. Bridget, you got something to mention?
I don't think so, other than say thank you very much for having us. It's always a pleasure. I hope you guys are good, and I really do think that the budget announcements are positive. I think it's going to be a bumpy ride ahead, but you know, a bit of positivity doesn't come amiss, does it? You know, there's some good. I think there's some good things that we can latch onto, and I think it's going to be a good time for business. So, thank you for having us, Dave. Thanks for the invite. Nice to see you.
Thank you, thank you, Lee, as well. We do very much appreciate your time, and thanks in general to Clive Owen for the help that you've given us over the last few years.
It's a pleasure. Nice to see everybody.
Yeah. So there are opportunities, as Bridget's saying, it could be a really good time for business. So I think we need to sort of look out for those opportunities and go for them. So. Okay then, if anyone's got anything else to mention, no. Just wish you a good day, and it's St. Patrick's Day, isn't it? I don't know whether we've got any. Yeah, Conway, Caroline Conway, that sounds like an Irish name.
My grandfather was Irish, and my children have great-grandparents that are Irish.
Right, well, you'll be dancing a jig in a minute with Guinness and your Irish whiskey.
Yeah.
Okay. Thanks very much for today, and we'll see you again in a month's time, yeah?
Thanks, guys. Have a great day.
Thank you. Bye.